Well, folks, I did it. I bought some Telus stock. We need to talk about why I'm buying Telus stock. I want to talk about the short interest, the dividend security. We're going to break down the balance sheet on the back of this rocky Canadian economy. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey by hitting that subscribe, especially if you enjoy these deep dives, because I wanted to start a position in Telus just to kind of keep my eye on it a little bit more in-depthly, because I think this company is a lot stronger and a lot more resilient than the stock price is making it out to be. If we zoom out, the company's actually wiped out about a decade of capital return, but in rocky market environments, it's not uncommon for this stock to drop up to 50+%, like the dot-com bubble, the 2008 financial crisis, but it's done a fabulous job at sustaining the dividend yield, increasing it, especially over the last decade, with a starting yield of 8%. There's a lot of concerns about the reliability of that 8% yield, and I think it's just really prudent today for me to kind of break this down as technically as possible. For those that are interested, not as financial advice, but if we take a look at the last year, I think what ended up happening going into the holidays is, especially in December, people were tax loss harvesting. So we saw a massive sell-off, tanking the stock by an extra 13%. And if we take a look at the year to date, however, we're starting to see more net buyers than sellers. And I think that's because some of those people that tax loss harvested are looking at it as, I can buy some of those shares back at a discount. And, they can finally buy it back after the turnover of that month, because in order to do a wash sale, you have to wait at least a month. And there were a lot of people in our chat group that I believe were doing that as well. And I kind of just picked some shares up today at around $20.08. A started position. I only picked up about 100 shares. Nothing too crazy, but just enough to keep my eye on it and just to see what the next earnings looks like in case the earnings actually start to stabilize a bit more. But we'll talk about it in a moment, because I think a lot of people's interest is the dividend that was able to increase basically up 7% over the same period last year. They increased it to 40 cents. And I really want to talk about some of the sustainability aspects of this, because people go into the statistics on Yahoo and they presume because the company's paying a 242% payout ratio that the dividend is eventually going to be cut. They're using debt or something to pay it. And I want to break down that's not really true. They can actually afford the dividend with quite a bit of bleed room. And we'll notice there's quite a bit of short interest here at 4.33% with mostly institutional ownership. But this short interest, I think, has the potential to lead to somewhat of a short squeeze. I mean, it's not huge short interest, but it's enough that if the stock pops off, that they will have to cover. And we could actually see some excelled performance from these current lows. That is speculative. Nobody really knows what the future holds. But hey, it's kind of incredible that the company was still able to take the dividend from 20 cents to 40 cents, and their earnings have actually been incredibly stabilized, right? And I think that's showing signs that the company is in a good situation, even on the back of the higher interest rate environment. Take a look at the annual revenue from 15 billion to 20 billion from 2020 has been some great growth. Quarterly, it's been a little bit more stable, around 5 billion, and you'll notice their gross profit has been largely unchanged, which really shows the resilience of basically telecom, right? Because you're not going to stop paying your internet, you're not going to stop paying your phone bill. If you put $10,000 into Telus today, it would give you $800 annually, which is probably more than enough to pay your internet and your phone, right? So I always love the trade-off of companies like this, because I think it's a really redundant way to think about investing, that hey, if I just invest X amount of dollars in this company, it would in perpetuity for the rest of my life pay for that bill. So, is it going to go anywhere? Well, probably not over long periods of time. So it might be, and it's an easy small amount of money. I mean, 10 grand feels like a really good trade-off for 800 annually if you're using it for that bill, right? So it's just kind of my thoughts, but let's break down the balance sheet a little bit more in depthly and get a better understanding of, where their capital is going, why that payout ratio looks so bad. But firstly, let's talk about the underlying businesses, because as mentioned, compared to like Bell or Rogers that have legacy media, Rogers really fixates on sports, whereas Bell has Crave, like CTV, some of the traditional news networks. I do not like that kind of media because it's been so capitally destructive, and people in my generation and younger go to TikTok, YouTube, and I think YouTube is literally going to become one of the primary entertainment services in the future. It is one of the most brilliant business models, and it's highly cost effective, huge margins, whereas legacy media comes with massive expenditures, right? Because YouTube doesn't pay for their content. So that's why I like Telus over Rogers and Bell, because you've got mobile network revenue, which is incredibly stable. I think there's going to be some concerns with perhaps the millions of people that have to leave in the next year. I don't know how many of them have, telecom networks with Telus, but on the other hand, you have to recognize that most people that live here, there's going to be no real population growth for the next 1 or 2 years, but this revenue is not going to go anywhere for the most part. And then you've got what's really intriguing is the health services, and on the back of, a supply and demand mix up with doctors versus people that that need doctors. A lot of people have been turning to telehealth because it's just a quick, reliable way to get onto a health network service and get immediate access. And this has been seeing a fairly nice steady growth along with their agricultural and consumer goods services, which has seen a 20% growth, year over year. So I really like the stability of these businesses. They don't say it in here, but they got fixed equipment and other service revenue, which is more related to probably the security side of their business, which actually saw a bit of a decline overall. But for the most part, I mean, their fixed voice services saw a little bit of a decline here. But in totality, we've seen about a 1.9% operating revenue rise. So again, very stable. All their businesses combined, like I said, we're not talking about massive growth, but I'm looking at getting the total return from the dividend yield. I think an 8% locked in yield today, if it remains sustainable, is a great place to start from the current price, and we could see some potential price appreciation. So from that yield, from the idea of sustainability, what we have to look is at essentially the dividends declared of 38 cents for the last quarter, not the recent one. And if we take that and times it by their shares outstanding, which I've done the math on, this is approximately about $580 million. That is what they're currently paying out in their dividend, right? So if we take the basic number of shares, which they have been diluting. This is a company that has done growth through dilution to pay for a lot of expenditures. A lot of these companies have done it this way, and it worked pretty great over the last decade. But in a market environment like this, it is really, really tough to be doing dilution. But again, with that $580 million, let's just talk about, what the breakdown does to get us, why they can't afford the dividend. Because again, if you look at in essentially the earnings per share, right, if we can find it on here, like the basic earnings per share is 19 cents. Nowhere near close to the 38. Even the adjusted EPS of 28 cents is just not enough to cover that dividend. But what it does not take into consideration is these depreciation and amortization costs. If you take a look here, for those of you that are completely new to this, I know some of you are OG, you understand this, like buying a car. If I work at a job and I go and buy a car and I buy it outright for 20 grand, let's say, that car is going to lose value every single year I'm driving it, but it's still going to produce the same amount of cash flow, like that $5 billion, right? But we're still going to be able to write down some of those, costs, because infrastructure for telecom is huge. But this isn't actually a direct expense because they already paid it pretty much up front, right? Like they've already paid for the infrastructure. It's paid for. So now it's just depreciating over time, but that's not changing the cash flow. But what they can do, and then the reason that this is a line item on a balance sheet is because they don't have to pay tax on it. Because the government allows you to depreciate the value of that infrastructure, it doesn't go into the direct income, right? So we can see the total operating expense is $4.3 billion. But depreciation isn't really an operating expense per se off that cash flow, right? It's not affecting the cash flow. So if we take a look at the net income, guys, we can see the income before taxes and then after taxes is $257 million, but they still have this 968, right? Which brings them up to about 1.2 billion, give or take, in cash, right? So that's how much money they actually brought in that didn't, like, in total. But all you're seeing is the 257 million that ends up being that earnings per share. So if they're only paying $580 million out in dividends, they have all this extra cash coming out of the depreciation cost, right, including the extra net income. What you can also take a look at is the cash provided by operating activities. This will give you a more clerical view, I think, because the cash provided is $1.43 billion in total. And you can see that they show this line, basically quarter over quarter, and it's always been enough to cover the dividend and then some. So there is a lot of stability behind the cash that this company is generating. Even with some of the free cash flow metrics can be a bit confusing here as well. I'm presuming, if I'm making any mistakes, I'm not a genius at this. I'm just some, clown on the internet. So take this with a grain of salt. And if I'm misconstruing something, let me know in that comment section below, because we can kind of learn and, build off each other from doing these kind of deep dives. But the more I looked into this balance sheet, the more and more comfortable I kind of get with where the company's going. Other than I do not like the depreciation. It's probably one of my biggest turnoffs in total. Like, it's just something that I don't appreciate as much. And obviously, like, we got to talk about some of the interest expense here as well, because that's going to start to turn into the other direction, in my opinion. Because if we take a look at that interest expense here, it has materially been going up and has been a rather large part of their expense. And we've talked about their long-term debt was 4.4% as of September 30th, 2024, compared to 4.33%. So we're seeing their turnover and their credit materially get higher. But now we're moving back to a place place where I think we're getting another Bank of Canada meeting very shortly, and I think we're going to continue to hopefully see interest rate cuts, which are going to bode much better for some of those cash flow metrics. So keep an eye on the interest expense. It is at 351 million right now for the quarter versus 334 million this time last year, over a billion. In 2024, they hit over a billion, right, which was up 10% in interest expense. That is not a small chunk of change, but again, if interest rates continue to materially go down at the rate they're going down, we could start seeing this materially drop off, which is what I'm hoping, because it would dramatically change again some of the cash flow projections, some of the earnings projections moving into the future, which is another reason I can't fully understand why the stock still is down so much, because I think, again, if everything remains stable, and I think there's a lot of concern about the economic downturn of immigration, but again, that is a short-term thing. I don't think it's a long-term thing. So I'm very excited to see what Telus stock does. Like I said, I only bought 100 shares just to kick off a starter position to watch it. I'm not interested in making this like a massive position, but as mentioned, I am looking to upperweight some Canadian dividend stocks just to maybe help bring in a little bit more dividend income as we look to get our total portfolios closer to around a 3% yield. But I do recognize that this is just one of the most fascinating stocks right now in the Canadian economy, and I just want to keep it on my radar for you guys because I know so many of you like it, and I'd love to know what you think if you're buying it, and your thoughts with the telecom industry in that comment section below.